I will start with background for this presentation. It's pretty much based on a recent paper, a strategy for rolling out climate de-risk insurance through regional collaboration. Here in the picture on the left, actually was a concluding workshop of ADRIFI 2, the ASEAN Disaster Risk Finance program. It's an ASEAN program supported by 10 ASEAN member states, and each member state has 3 organizations: Ministry of Finance, Insurance Commissioner, and the Disaster Risk Management Office. So you can imagine get such a project started, taking 30 organizations to agree on a project. Yeah, it took quite a bit of time. In fact, that's how I got involved when I was a professor at NTU. Later, I kind of came to Shenzhen, and so my team, my Lighthouse team, kind of work on this project. So a lot of the main ideas from this for this paper actually came from that work advising ASEAN member states on disaster risk finance and insurance. On the picture on the right is actually the award given to this paper in Osaka, Japan, at the Asia Pacific Risk and Insurance Association. And I said this promise is a very simple paper. The key points are, just in case get sidetracked, climate change is a global challenge, while disaster impacts are local. And most ASEAN countries have modest income and low insurance penetration, which face rising exposure to natural disasters, which I think we all know. So just like the title, in this paper, we propose forming or using some existing ASEAN regional insurance pool to roll out, here's the keyword, climate de-risk insurance, or CDRI, or some people can say it's CDRI represents climate de-risk investment. So that's really the key phrase or key idea. Let's now just get into the content, we're like peeling cooking onion layer by layer. Let's start with climate change. The future paths of global warming in terms of climate change scenarios for the future years. We heard a lot of panelists talking about this at this conference. Yeah, whether it's 2% or 3% warming, over the next 80 years, that's one metric. However, I think locally already, we don't have to wait for 80 years. Already happening this year, like headline news, we see the volatility already increased. Volatility I would call the volatility spike. Volatility spike or the delta spike. So we see dramatic changes, large spikes or delta using the kind of a financial engineering language. In rainfall, some places see unprecedented flooding, some places experience extreme drought. Actually, flooding and drought, sometimes they come they're correlated. You have a lot of flooding, normally could be followed by years of drought. That's just part of nature. We also see large spikes or delta spikes in temperature. We see extreme temperature in Europe, Asia. I think many of us already could feel it. For the northern part of the hemispheres, we had extremely hot summer. And we also see large spikes in forest fire and changing seasonal patterns. If you talk to winemaker, the vineyard, they can tell you, those changes are already here. So here's the thing. We see large spikes, which actually caught many communities unprepared. for example, the recent flood near Beijing, around Beijing, it was so surprising. So basically, many communities, I think there were extreme weathers, but they got used to it. However, they were not prepared for those new patterns, large spikes in this new weather pattern. So if you use game theory, if communities already have a defense line, but now the defense line is no longer adequate, so that could not withstand this Delta spike. That's kind of current reality. So how the insurers are reacting? We see that global insurers generally are reacting by price increase because they suffer such big losses. We all know. And we know that some big insurers in the US are withdrawing new home insurance coverage from California and other high-risk areas. Those are headline news. So insurers are, for the most part, withdrawing or shrinking from this. That's not the whole story. We know many global insurers are very proactive, wanted to play a more active role in countering climate risk. And the question is how without getting burned. Now coming back to Asia. Here I think we all know the insurance penetration in Asia is quite low, relatively lower than Western Europe and North America and Australia, if you will. So here's the question. What role, for Asia doesn't have strong insurance industry to start with. Actually, if we withdraw from it, for developed countries, insurers are kind of, there's too much risk, we need to step back. But for Asia, we don't even have a strong insurance industry. What's needed is to grow the insurance industry. So with this climate change, how can the insurance industry to grow in Asia play a bigger role? That's the question. Yeah, so the basic facts are in Asia, the asset exposure to climate change is rising. We have in Asia, we have very dynamic emerging markets with young population and quite fast economic development. However, the insurance penetration is low. And with that, Asia's, especially low-income countries, are becoming more vulnerable, and with widening protection gap. We heard reports, studies on widening protection gap. Probably some of us attended the GIP recent report on widening protection gap. The question is how to reduce the protection gap. What can be done, right? It's a very fundamental question. From this ADRIFI 2 project, the past 3 years, just one conclusion is the following. Asian governments must be proactive in building resilience. So for the insurance industry, whether it's a local insurer or global insurer, must find ways to engage the public sector. The public sector, we're talking about the Ministry of Finance, insurance commissioners, and in our project, we actually discovered that Asian countries are quite proactive in, for example, the Philippines, Indonesia, the governments are very proactive. And they even have legislation to allocate their budget in terms of budget allocation. We know budget allocation is a big thing in Asia. In Singapore, every year, the government budget allocation is the biggest event because it impacts so many parts of the economy. So for Asian governments, they already allocate some of the budget to disaster risk financing and the insurance. And also the central government will allocate the revenue, the budget to local government units and ask and tell them you can use this to buy part of the fund to buy insurance. However, local governments currently they're not many of them are using the allocated fund to buy insurance because, well, if we get hit by big disaster, we go back to central government again, ask for aid. So that's the just elaborate a little bit more on this point. I think development banks are trying to educate Asian governments. So you need to buy insurance. We give you a loan, say give you $5 million US. Why don't you try an insurance program? And then I think some of the countries actually, yeah, okay, we'll try it. We don't really understand how insurance works. We'll use this loan to buy insurance. And somehow they designed the trigger, so high, multiple trigger, different conditions, how many population get affected, parametric trigger. After 3 years, nothing happened. There's no insurance payment. So countries have not experienced so much of the benefit of insurance. With some exceptions, I think Philippines tasted the usefulness of cat bond. They had a cat bond, got triggered, but now even with the price increase, they are still unprepared. Wow, we were able to buy, to issue cat bond to rely on capital market for protection. But now with the price increase, well, what should we do? So the key point to repeat again, insurance companies must find a way to engage Asian governments to help them to build resilience. So to build on that point, the insurance industry needs a paradigm shift. In fact, firstly, insurance industry should look at climate risk not just as a challenge to the existing business model, but also opportunity for growth. And building resilience will generate $1 trillion of economic activity. In terms of new sector, risk management sector will grow because that's a must. If the human race will want to survive and prosper, the risk management industry dealing with climate risk will grow. It's a multi-trillion-dollar business. And insurance industry has to find a way to play an active role, be part of this. And even for countries, how countries are addressing climate risk will determine the future path of economic growth. So I think conceptually, the audience would agree with me. Yeah, Professor Wang, what you're talking about, we agree. The question is how to do it. So in this paper, in our proposal, is to propose a product innovation. And to put simply, to integrate traditional insurance protection with mitigation. And how to do it? It has to be through collaboration. We have horizontal collaboration and vertical consortium. I will actually expand on this. Let's continue to peel the onion. Paradigm shift. There is just from an actuarial principle, or like the insurance 101, law of large numbers. So by pooling risks, the volatility get reduced. Here on the left-hand side, the volatility get reduced, the cost of capital get reduced, but the expected loss does not change. And on the right-hand side, with this paradigm shift, by integrating mitigation with insurance protection, so we see the largest bar this fact loss will get reduced. So mitigation can reduce this fact loss. That's a benefit. So actually, we have developed some analytical frameworks. This is just to illustrate how to integrate mitigation and insurance protection. It's fascinating. But here's the simple diagram to illustrate impact. Okay, now we're getting to the core of the onion. We peeled several layers. So what's this product? This product, we give a name CDRI, Climate De-Risk Insurance, or someone may like investment, say Climate De-Risk Investment. So basically, in a nutshell, is to designate a portion, say 10%, 20% premium for risk assessment, risk mitigation. This again sounds like a simple idea. I think I need to expand further. And how to roll out this product, ideally, especially for Asia, it should be organized maybe through a regional pool, and I will explain why. Why using a regional pool rather than just traditional insurance operation. And the regulation hold the key for this product. I need to expand a little bit because otherwise it looks too simple. So yeah, maybe let me first explain this, and then we go back to the to explain a little bit more on the product. The product design. Here's the. Let me see. I need to move this. Okay. Here's kind of CDRI product design. Firstly, the product will provide very basic level protection. The limit is it's not like traditional catastrophe insurance where high limit protection. So capped at a multiple of the premium. So firstly, low limit protection. Why low limit protection? It's not full insurance because most importantly, post-disaster, those communities need immediate fund for emergency response, rescue, more like an immediate liquidity need. The reconstruction cost would cost a lot more, multiple times more, but that comes later. But in terms of benefit, bang for the buck, the timely payment post-disaster is very important. So that's why we're proposing very low limit and it's multiple peril. The current insurance normally is peril specific. You have so many fine prints, what's covered, not covered. So basically here, without much argument, you suffer loss, this policy should pay. So it's multiple peril or all peril, if you will, but the low limit. And who pays? So basically, you look at this one, the public sector should pay majority of the insurance. So this is not micro insurance, it's not individual insurance. I call it meso. Micro, meso, and meso is more community-based. Can be bought by the local community or city or district or province. Is community-based insurance. So the public sector will pay for the premium, whether part of it will come from the local government budget, or the local government already have a budget, and some of them can be used to buy insurance. And more importantly, we have multi-development banks. They're offering premium subsidies. So basically, even for low-income countries, there's still funds available to buy insurance. So see, the public sector pay for a big part of premium, and the covered individuals will contribute to a small portion of that premium. This actually going to do magic. I mean, in our research, we have data, for example, the agriculture insurance in China grew over the past 20 years from almost nothing to #1 in size globally, because the government pays for about 75 to 80% of the premium, and the farmers only pay for 20% premium. So the insurance premium grows about 20% per year, even during the COVID years. The economic actually didn't grow, but the agriculture insurance continued to grow at 20% per year. So, and here the vertical split is part of the premium, say that's 20%, premium were designated for mitigation. Mitigation including assessment, some of the mitigation measures. So the benefit of the green one, on the mitigation, will be realized economic valued by mitigation, and the yellow one will, cover the kind of insurance protection. And individuals or communities, they can buy commercial insurance without public sector subsidy. Is the extra premium on top, lay over the basic coverage. So this is the design of the product. Let me address again. This is very different from the traditional insurance we are used to in North America, Western Europe, etc. Because the current insurance are more peril specific, with a lot of fine prints, lots of exclusions. And we're here offering some kind of low limit multi-peril insurance that provide immediate liquidity. Okay, I hope. Okay, the region, why region, we're proposing to roll out this product through regional pool, because the regional pool can help. It's a fast way to roll out product in Asia. So basically enable multiple countries to participate at the same time. Design a simple risk transfer product, CDRI product, provide immediate liquidity and also sum the premium to be used for mitigation. The mitigation part actually the insurance company doesn't have to do it alone, because part of premium can be used for risk mitigation, risk assessment, and our can join other funds available, other projects, to support that the local government is rolling out. So as long as the key is that the insurance company has that expertise to do risk assessment and to design to find the optimal, most effective mitigation project, and what's the reasonable budget, what's cost benefit. Again, here need a lot of actuarial work, so that insurance companies are contributing to the economic, not only resilience, but also local economic development for the community. And rolling out CDRI products through a pool can also pool our knowledge. What mitigation measures can be activated, can be implemented. There's a lot of international experiences. Pooling is not only pooling of capital or funding, but also pooling of expertise, database, and through this pool, you can actually, very practical, you can invite some pilot local government units. It doesn't have to be the national government. We already see some successful pilot studies. The local communities really appreciate, especially the funding from the development banks, and also the involvement of the insurance industry in their local economy. So I believe this is doesn't come from pure academic ivory tower research. It's based on that project, field study, talking to the public sector, ministry finance people, the budget, management officials. And the key is by this innovation is very much needed. It's not just, it looks good. Without such product innovation, the local government cannot feel or experience a tangible benefit of insurance. Unless they can experience tangible benefit, there won't be any trust. Otherwise, they cannot really trust what the insurance can do for them. I mean, this morning, Mr. David Koenig, actually, he's an expert on risk governance. Actually, he actually spoke on this about how to build the trust through not backward, but not feedback, but feed forward loop. So we believe that what we're proposing actually will fit in with his risk governance framework. And yeah, so this proposal also has the potential of unlocking efficiency through this platform. The regional pool can be in operation, enable different countries to participate, and we only need a local insurance carrier to help to kind of roll out those insurance contracts as a local carrier. And we're also through a digital platform, actually we can mobilize risk management agencies. Those risk management agencies, not only to do the distribution, but also the help with the risk assessment and risk mitigation. If they don't have to do it, I mean, they can help to facilitate, I even engage third-party service providers, risk mitigation service providers. So at the end of the day, going to be a consortium of service providers, not just the insurance companies. I mean, we can engage the satellite image, providers. We can engage blockchain companies for the claims disbursement or that. So there's a huge potential in terms of efficiency if we build into the digital technology into this. Let's see, let me look at the time. Okay, have a little bit time left. So for actuaries, there's a lot of work for actuaries. Here I just illustrate, we have many CAD modelers. I mean, Andreas, our moderator, is one of them. So here, with how mitigation going to shift the loss exceedance curve? I mean, there's a lot of study. Actually, there is a lot of the studies already being reported by international organizations. They use this benefit cost ratio, like from more than between 2 to 10. So every dollar invested in mitigation, there's like 2 to 10 times benefit. However, as actuaries, I see that concept is not very mathematically precise, because the benefit cost ratio also depends on the frequency of future disasters. With climate change, that frequency is changing. So really, I think we actuaries can do a lot more than just just a simple benefit cost ratio study. And also, our research team are currently doing this study on compiling those mitigation measures. What's the cost, how much the budget, was spent, and how much loss reduction was realized. Anyway, so we can actually, through those data, we can build a frontier of the most effective mitigation measures. We believe that this is actually, I'm almost there. This is the very much needed, closing the protection gap. So we're proposing that CDRI product will be the bridge, bridging the gap. And finally, the most important part is the enabling regulation, because for this type of product, we don't have to use the traditional insurance regulation on pricing or solvency. Even though I think the solvency capital requirement can be much reduced. And a big part of the insurance regulation will be on monitoring how the funds are used, how effectively the funds are used to reduce the loss, and also whether the insurance pricing will take into account of risk mitigation. So for actuarial profession, we need to develop data analytics standards benchmarks so that we can enable this product to be rolled out, enable the regulators. I think actually in terms of time, hold on, it's time for some feedback from the audience. I would like the the secretary to do the ask some questions now.
Thank you, Shaun. Thank you, Shaun, for a lively and fascinating presentation. We have time for, let's say, maybe 2 questions. Shaun, you have already answered one of my questions on slides 15 and 17, I think. You're absolutely right. The regulation probably needs to be adapted so that this product actually can reduce the risk-based capital. Would you like to say anything in addition to that? Just briefly.
Well, you are an expert on CAT modeling. We know that as long as the insurance covers CAT, the loss exceedance curve, the 100-year event, if you will, somehow being used to decide the solvency capital. I think a lot of work can be done there. I wouldn't get into the specifics because of the time constraint, but I believe this is something the actual profession and the CAT modeling community can, join hands to collaborate to provide technical support for regulators. Yeah.
So we will probably park the second part of this question and we will re-ask this question later during the CAT modeling panel. We will park this question and allow maybe one more question from the audience, hosted 3 minutes ago by Mr. or Mrs. Anonymous. I'm reading the question. This sounds like a great idea. However, there are some operational complexities. For example, having a regional platform with the local companies providing the insurance to the masses. However, some countries have restriction on sharing of data across borders, especially policyholder data. What are your views on such operational complexities and how can this be overcome by them?
Very good question. I mean, sounds like this person, lady or gentleman asked this question already gave a lot of thoughts. Indeed, I'm in agreement that there is operational challenge. That's why in the kind of the one key message is through regional collaboration. For the ASEAN community, I mean, the fact that the ADRIFI 2 project was carried out, I think ASEAN member states are working closely to collaborate. And so there is trust in that community. Now it's called ASEAN +3, I think working with the other 3 countries. There is a trust and the data is actually part of this initiative to enable the local provider. So we're not trying to, actually the aim of this product innovation, this approach to enable local government to develop their economy. So the data part, frankly, if you ask for data sharing, they don't have a lot of data. Trust me, we are always ask for more data. However, in the process of rolling out the product, data will be there, will be collected, will be available because once you have transaction, the data is for real. I mean, without transaction, all the data are questionable, frankly. Yeah, through this regional pool, it can be done so that the data, some of the sensitive data will sit within the country. However, the platform can still provide methodology support. So my question, yes, as long as there's trust. So in order for countries to trust, they have to see what's really tangible benefit, the forward-looking, not back feedback, but feed forward. With especially international development banks co-fund some of the premiums and co-fund some of even the development costs. I believe that local governments will be very acceptive. Yeah.
Thank you, Shaun. There was one more question. I gave the questioner your email address, so he will ask his question to you offline in the interview.